Wow, you guys, why don't another round of applause for one of my heroes, one of my mentors, Charlie Paparelli. Thank you very much. With that, I'd like to bring up my panelist for the next part of our presentation. Charlie, let me just say again, when you think about successful entrepreneurs and you think about being a servant leader, Charlie's at the top of that list. The number of businesses he's done, the number of things he's always about being the servant leadership to see how it can help. And I think there's a lesson for all of us. We need to all figure out how we can give back.
Check. Check.
Check. Is everybody ready for the next part of the panel? Yes? Yes? Well, my name's Karen Robinson-Cope. It's a pleasure to be here. It's especially exciting to see so many of you here, so give yourself a round of applause because you're all here. Thank you very much. I've been a serial entrepreneur for many, many years. I think I'm a recovering entrepreneur because I've not quite figured out how to get out of it yet. But absolutely love starting companies, building companies, and most importantly, what I love now is helping others to build companies. Let me start by saying a couple statistics. The first one is, did you guys know, according to MSN in December, that 2 in 5 Americans are going to try to build a business this year? 2 in 5. How many of you are either started a business or going to start a business this year? Oh, come on. Keith, raise your hand. I know you're one. Okay, quite a few of you guys. Good to see. Congratulations, and I think Charlie's given us some great feedback to start it. I think the next thing that's equally interesting is that 1/3 of those businesses will be started with less than $5,000. Not $500,000, not $5 million, not $50, $5,000. It's important. I think it's important to note because we too often think that you've got to raise millions of dollars, and yet 1/3 of those businesses actually need less than $5,000. However, the next thing that I think is important to note about is that cash is the #1 reason that companies fail. 44% of failures of businesses are because they run out what Charlie called the cash. They run out of the cash. They look at that bank account, and there's nothing in it, and they don't know what to do. And equally important this year is that fears of a potential recession are really hurting the investors today. There's a complete concern, there's fear, and people are not quite sure, and you're seeing that for many companies that are having a hard time raising money. However, the thing that I want to talk about before I introduce our panelist is that saying that there's $300 billion of dry powder, that's available in venture capital arms, and they need to deploy that. So even though most of you who start a business will start it with less than $5,000, even though there's a recession looming that people are fearful of, there's still $300 billion, according to The Economist, of dry powder sitting around. So what I'd love to do today is introduce you to 2 of my friends that have successfully raised capital today and in prior companies. They've gone against the trends, and we'll tell you a little bit about how they've done it. And let me start by introducing a friend from Florida who've come up for the day. Welcome to Atlanta. He's come from Florida. It's Howard. And give him, thank you. Round of applause. Thank you. And I'd like to start by just saying Howard has just completely broken all those trends because he recently closed a $60 million round not too long ago, in spite of all those fears, more than $5,000, and a very interesting industry. So let me turn over to you, Howard. Tell us a little bit about you, your background, and how you got started.
Sure, thanks, Karen. Thanks, everyone, for having me. Really appreciate it. Charlie, thank you as well. Really appreciated those words. And as a tech-enabled services company, completely understand the passion there and what you've done. I guess a bit about me. Originally from Canada, moved to the States back in 2006. I was about 25, moved to Seattle for my second job, and have stayed ever since. My background is really a combination of starting and growing companies as well as investing in early stage companies. And so kind of have been on both sides of the fence in terms of that. I guess what really gets me going, I love technology, I love building things, and I love helping people. And so that's cheesy, I know, but it's true. It definitely is what gets me up in the morning and what fires me up. When it comes to CharterUP, I'm not the founder, but I guess I'm the number 2 at the company. I met the founder about 4 years ago after I had just stepped back from a company I had started onto the board of that company and was looking for companies to invest in. And I met Amir, I met the team, I heard the vision, saw what was happening, and I was sold. I wanted to invest and was told, wait, I don't think we need your money, but we could probably use your advice. And so after a few years of providing advice, I joined full time, and that was just over a year ago. So that's kind of the quick story on that. We're now about 150 people. We are hiring on all cylinders. If you know folks in sales, operations, technology, customer success, I wouldn't be doing my job if I didn't get the advertisement out today. So appreciate all the leads that are going to come to howard@charterup.com, even during this conversation. So appreciate it. All that said, we did go through a fundraising, our first fundraising last year. We were bootstrapped up until that point, went through some really hard decisions and really hard times during COVID when we saw a negative 95% demand shock overnight. And we had some business and mission critical applications that kept us alive, but we managed to persevere, and all the investments we had been making in technology just really came to fruition as we came out of COVID. For those who don't know, so CharterUP, we are the, I guess, only, but certainly largest tech-driven platform for large group travel in the US. So if you want to get 20 or more people on the same vehicle going somewhere, we're the place to do it. We'll make it super easy for you to find and book a charter bus, minibus, whatever it might be. If you need 50 of them for your conference, we'll do that too. If you're going from San Francisco to New York for some reason and don't want to fly, we'll make that happen. We can do whatever it is. And so think of us as Uber for large group travel. Is that...
Just a little bit more. Tell us a little about the timeline before we turn to Brian, because again, in this tough environment, you were successfully able to raise $60 million. Is that the correct number? $60 million.
Yeah.
Tell us a little about the timeline and again, when you started the process and who did you reach out to?
Oh my goodness. Okay, so the timeline was long. We started started having a few mentor-style conversations about a year ago. It was probably last February that we were kind of in the warm-up phase of it, and it was probably around last April that we really started going to the market. So we were in the heat of it as things were re-rating every few weeks, and the Fed was jumping interest rates by 75 basis points, and the markets were just really coming down. And so we felt that pretty hard from a lot of the conversations where I think people were really interested in what we're doing, but they were not necessarily investing. They weren't investing in the same way. We had investors who said, hey, look, like, we love what you're doing. Now is just not the time. We don't know where this is going to shake out. We had other investors who said, hey, look, like, here's what you probably would have been worth if you were fundraising 6 months ago. Those were fun conversations, right? That's what you want.
Hard conversations.
Exactly. Your baby's beautiful, and it was a lot more beautiful. Those are interesting conversations to have. I'd say having been through probably 4 fundraisings myself as an entrepreneur, prior to it, having been on the investor and board side, I've always thought of it as if an investor is investing in 1 out of 50 to 1 out of 100 companies they meet, as an entrepreneur, you got to meet 50 to 100 people to get to a match, and it's kind of that equation. I'd say that probably matched our experience. We got, I'd say, a lot of interest, but then when it came to people who were still investing and were understanding of the space and were understanding of our technology, and you got to go through all those qualifying criteria, right? If you're an enterprise salesperson, you're doing the exact same thing. We probably got down to about three or four, really 3 different firms that looked like really good opportunities, both us for them and then for us. And so that was kind of the process. Is sort of the rest is history. I'd say the post-LOI diligence phase was also long. I think any investor at that time is going to say, wait, like, we want to see, like, are next week's numbers going to come in the way you think next week's numbers are going to come in? And that's a lot of pressure when you're sort of in that zone. But I do think someone says, it's luck. I call it good fortune, which is hard work and luck coming together. Just hard work wouldn't do it. Just luck wouldn't do it. And so that's kind of what I say.
You guys, that's a great example, and there's a couple things I want to draw your attention to. One of them, you got to kiss a whole bunch of frogs before you get there, which means, guys, if you fall in love with one VC or one angel investor, you better be talking to a whole bunch more. I mean, significantly more. Number two is give yourself time. You heard him say that. These were very successful entrepreneurs. They'd done it before, and yet they realized, and this is before the recession. This is still back when the go-go days, and yet they still gave themselves months to be able to pull it together. And the last thing that I think is important, especially now in this time, because I think quite often we entrepreneurs, we can get the money, we're so excited that we're just like, wow, we're so excited. Listen to what Howard said. He really checked them out. He did as much due diligence on them as they did on him. He wanted to make sure that the match was there, that it was going to be a successful marriage, and 5 or 10 years into it, if it goes that long, that both parties are going to be happy. So folks, even in a time like this, you all need to make sure that it's truly a good match and you're both well suited for each other. Those are a couple things I hope you heard from him. We'll talk a little bit more, but let me turn to my dear friend Brian. And Brian has also been a very successful entrepreneur in a number of companies. He's now done a little bit of a right turn, if you will. And I'd like him to tell a little bit about his history and then what you're doing now, because I think it's very exciting.
Sure, thanks, Karen. So I'm Brian Zwerner. I spent 20 years in capital markets, investment banking roles in the US and overseas, and then here in Atlanta since 2008. Ran 2 startups in the 2010s, a fintech-enabled healthcare small business lender that we sold to a strategic in 2017, and then a high school sports startup that was a ton of fun, but of a terrible business model that we shut down in 2018. Through that, I met a large number of former NFL players that were helping me with the stuff we were doing with high school football. And one of them worked with me to start the group that I've been running for the last 4 years called Beyond the Game Network. It's a group of about 30 former athletes, mostly NFL players, a couple men's and women's athletes in other sports. We invest in startups where having athletes involved can help the businesses. So all direct to consumer and in entertainment makes up about 70% of our 23 portfolio companies. Sports, media, gaming and esports, sports gambling and fantasy, and consumer Web3. That's entertainment bucket for us, about 70% of what we do. And then about 30% in fitness and health and wellness. Fitness trackers, workout devices, fitness apps, coaching apps, and things like that. We invest from seed to Series B all across the US and selectively overseas. And then we bring this big crew of 30 athletes to connect in and provide value to our companies. Brand ambassadors, content creators, introductions to pro and college sports teams, media groups, players associations. We're deeply connected across the sports ecosystem, which can help for an even non-sports company, just given the power of the sports businesses. And I've been doing that for about the last 4 years and change. I've made dozens of angel investments outside of that, mostly in the same areas. So see thousands of deals a year. You're 100 to 1. I'm probably even worse than that, but somewhere in that range is probably somewhat reasonable. The vast majority of the stuff that we get inbound is totally outside of our parameters, which are like clearly spelled out on our website. And then, as Karen alluded to, very passionate about working with diverse builders here in Atlanta. Started a nonprofit venture studio late last year. It was announced a couple weeks ago, called We Studio, written out as W3. We Studio, it will take donations from corporations and individuals into a 501c3 nonprofit. We will take on diverse founders, Black, Latinx, and women founders here in Atlanta, building in Web3 at the absolute earliest stage of ideation. Idea on a napkin, I think I know what I want to build stage. We will work with them to bring mentors and advisors to help them get their businesses live. We'll replace the friends and family capital round with $200,000 in non-dilutive grant cash from our nonprofit, and we'll help them get those businesses running. So that was announced a few weeks ago. We're in the fundraising mode for that nonprofit now. and we expect to be live with founders in the spring. So lots more information coming on that soon.
Thanks, Brian. And I think 2 comments. I think number one, again, I love the statistic, thousands of companies that look. But I wanted to draw your attention to one thing he said that it's very important. Your time as an entrepreneur is incredibly valuable. It's the most important thing you have is your time. And shipping off business plans and emails to people that have no, that are clearly stated. He said, on my website, it's clear the plans we take. And yet you get thousands of inquiries. Think about the time that an entrepreneur is spending on sending those emails and business plans to people who are clearly, and you're probably going to tell your other investors, oh yeah, I'm talking to Brian, it's good news. And Brian has no interest in doing that. So guys, be aware your time is very valuable, and it's important that you really, again, both gentlemen have said this, you need to research their investors, whether they be angel or VCs, as much as they're going to do evaluate you. It's really important. The other thing he said that I really love is that, just like Charlie said earlier, he had a very successful career first in investment banking, then he went into some startups, like many of us. I don't think you're a true entrepreneur if you haven't failed at least once. He did that, and we're very open about our failures, but then he clearly said, here's another opportunity I can take advantage of. And it goes back to that servant leadership that Charlie talked about earlier, and that, again, here, we're a very fortunate group here in this room, and so I am going to continue to encourage you guys to find other companies that you can help work. Let me talk a little bit about trying to raise money for a nonprofit. Tell us a little bit about that, because it's for a nonprofit, but it's for entrepreneurs.
Yeah, it's still early days, so just getting started, talking to some of the biggest companies in Atlanta that have a history of supporting diverse founders. That's something that we're seeing a lot of companies creating DEI initiatives, and we're leaning into that pot of cash. So early response has been great. People are really excited about what we're doing. On the traditional fundraising side, Howard referred to it, it is a very difficult capital markets. In the startup space right now, very few things are getting funded. You might be seeing things in the press that are announcing rounds that are happening. Those rounds happened many months ago in many cases. Some of those rounds might have happened a year ago, and they're just being announced today. So don't confuse that. That doesn't mean that those rounds that you see in TechCrunch happened yesterday. That's almost never the case. I don't know when your round was announced relative to when you guys did your deal, but it can be months. So that's something to keep an eye on. Deals are still getting done. It is very hard, but you have to have all your ducks in a row. You have to be like Howard's company. You have to have the metrics. You have to have the numbers. You have to be delivering on the things that you're doing. Most of what we're seeing being pitched to us as an investor right now are some combination of bridge rounds, insider rounds, and down rounds. And none of that's attractive to us, and we want no part of any of that. But that is a lot of what's happening right now, existing investors funding companies. I don't know what you saw as you got out there and talked and what kind of response you had from your investors.
Yeah, I mean, we were, I guess, on the fortunate side, right? We closed the round, we raised a large pool of capital, we got great investors. It's Tritium Partners, an Austin-based fund that had a lot of expertise in our industry as well, which was really helpful. We're also probably a little bit of an outlier. We did do our press release actually relatively shortly after the round, so and we were run rating $150 million at the time, and so we were in a very good spot. And from like a call it first round of capital, I know in my prior company and most of the companies that I'm invested in or on the board of, raising capital long before sort of that point. And I would echo what Brian's saying, like the number of companies I'm involved in where they're raising insider rounds and getting to 2/3 of the target, or they go to the insiders and folks said, look, like we just haven't seen the sales traction. In a better environment, we'd keep going. We should start pursuing a strategic exit. Or hey, we've got capital, we've got runway, but we're not sure that later this year is going to be a good fundraising environment yet. So let's actually start thinking sooner rather than later about making adjustments so we can be, near break even and just continue running along. That's kind of where we're at. It's tough. It's tough out there. And I talk to friends at venture funds who say, look, our top 2 portfolio companies from a performance perspective, they're having tough time getting insider rounds done. And so I think that'll turn around. Be interesting to hear from Brian on the other side, like what you think. But it's going to turn around. It's got to turn around. But it is tough right now.
Well, remember, there's that $300 billion of dry powder sitting on the sidelines. The LPs do not put money in to keep it in a bank account. They really want them to be deployed. So I agree the business is going to come around. But two things you brought up that were really powerful, both you guys. I think number one, again, be prepared. This is a long planning cycle. We don't wait and one day say, oh my God, I'm out of cash tomorrow. What do I do now? And I think the second thing that we need to make sure is continue, especially in this tough environment, we need to really be managing our cost. I think the days of grow at all cost, the days of, spend whatever it takes to get that growth, those days are over. And we need to make sure you as CEOs and as entrepreneurs need to make sure you're managing your business such that you can see a clear path to profitability and understand what your investors are looking for them to fund the next round. What do they need to see from you? Is it revenue? Is it profitability? Is it users? Is it impressions? Most probably it's going to be revenue and profits, but make sure when you get that round, it's not too soon to say, okay, let's make sure we understand what happens next. Because again, it is a relationship, it's a partnership between two people. Let me change subject a little bit if I could and talk, you can't raise money. So what are some other ways? We've all been entrepreneurs. What are some other ways that you might be able to raise money? And I'm going to take a couple that came from, again, The Economist. One of them is that 20% of business owners utilize rollovers, also known as 401k. So they're pulling money out of their 401k. If you really believe in it, that's one way to do it. 10% of business owners are still relying on their family, their friends, they're called the family and friends round. And so I think, again, as an angel investor, I do often question if an entrepreneur is coming to me and asking me for money and they haven't asked their family and their friends. That is a little bit of a red flag for me. Because, again, if they don't believe in it, then why should I believe in it? One last one is, again, loans. And we are seeing more and more loans that are starting to be available. So those are a couple. Gentlemen, what are you seeing, or what have you used in the past, or what are some creative ideas?
I mean, I'll take a second to respond. There's one other line on like what percentage of companies fail because they run out of cash. I'm convinced that that's the only reason companies fail. If you don't run out of cash, you haven't failed. I mean, you can decide to stop, but like running out of cash is the only reason companies fail. I think it's really tricky. I mean, people talk about customer-driven funding, and you can pull out every stop to try and get your customers to pay on time, pay early, pay full year in advance. I think this time in the cycle, the companies themselves don't want to do that. They're pushing back. There's just tightness in money supply, period. And so I'm a little bit of a bear when it comes to these sort of alternatives. And I've seen companies do this and go through it, which is, hey, we aren't hitting our financial metrics, and we're going to be running out of cash, but making the tough decisions around burn, around personnel, around extending that runway, that's a painful decision to make. And people put off short-term pain for long-term gain, right? People don't want to incur the short-term pain, and you really, as an early-stage entrepreneur, I think, take a tremendous amount of business continuity risk by not enduring the short-term pain. I've been through cuts. It sucks. It sucks. If you haven't been through cuts, that is a reality for a lot of entrepreneurs. It really is painful. At the same time, the alternative is not being at scale and taking out from your 401k and paying penalty tax on your 401k, or taking a loan that is going to get personally secured against, against the house. I mean, and this is not a, hey, we've got a short-term play, we've got a big contract that's coming in, but we just need 30 or 60 days of working capital. I mean, there's still people to fund that, right? If you've got government tax credits that are owed to you, you can go and factor that at 4% or 8% or some number. It might not be cheap, but it's totally doable. If you're in the zone of we're ahead of our skis on how much we're spending versus where the business is, the sooner you can face that reality and pull up, the better it'll be. And by the way, I'm a big believer of this with people conversations as well, right? If someone's not performing, care enough to give that feedback early and be upfront about it, deliver it in a thoughtful, caring way, but I don't want to delude myself into thinking I'm actually being nice to them by not telling them that information. And it's a little bit of the same thing if you think of your company as your child, and I don't have kids, so people with kids will correct me on this, but it's my job to teach the lessons that the world will otherwise teach it if it gets to just go out in the wild on its own. And so it's going to be a lot better off if I teach it those lessons early than if I allow it to get run over by a car. Bad example.
And
Sorry.
it's so true because remember, folks, that being an entrepreneur, you're in a marathon, and you don't know if you're mile 1 or mile 25. And so it's important to remember that it's a long slog, and so you can't just worry about those next 30 days. Brian, one last comment, and then I want to open up to questions.
Yeah, I mean, look, money was abundant the last 4 or 5 years, and the advice from venture firms was growth at all cost over anything else. That has changed. If you haven't figured that out yet, that's over. You need to find other ways to fund your growth. For very early stage founders, not just what we're doing at We Studio, but there is a lot of grant money out there, especially for diverse founders, but for all founders. There are grant programs being run all across the ecosystem. Look into those, chase those, they're out there. Pitch competitions is another place that I've seen founders in the earliest stage find 10 grand, 25 grand, 50 grand, even more sometimes. So those types of alternative funding sources are there. I have seen some people have success getting money out of their customers. If your product is truly great and your customers really love it, you can offer them a discount to pay up front for the year, do it. Don't even think about it. Just get that money in the door.
Absolutely, it's non-dilutive.
Yeah, we've seen, even seen a handful of companies offering lifetime passes for things like software or memberships to communities or things of that nature. And might be a discount, but at least it puts cash in there and you're not giving up equity to do it. I'm not a fan of venture debt. I think venture debt is very scary. It creates all kinds of problems down the road. If you're, any of this kind of small business lending debt, I lived it for 3 years. I saw the problems it created for a lot of the borrowers. You do have personal guarantees on the vast majority of it. It's a real problematic area. There are times where venture debt makes sense. If you're in some type of a consumer product business and you're selling something and you know that if you do $100 of Facebook ads, you're going to get $200 of sales and that's net unit positive, venture debt all you want. But if you don't have something very clear, if you're just spending on operating costs, any of that kind of debt in an early stage startup it's going to kill you. It's just going to kill you, so be careful.
It's a great comment. So let me open it up, if I could, to maybe a couple questions. Sid. So the question is, Sid asked, at what point would Howard consider a down round or a flat round?
Oh my goodness, that's a tough one. My first reaction is I wouldn't, but that's not really a practical sort of response. I'll speak sort of outside of, call it CharterUP, and I hope we're not, ever in that circumstance. But I'd say, look, there's a requirement to be pragmatic, right? And I think that pragmatism is going to show as an entrepreneur and as a venture investor. My advice and my practice is, look, when I'm raising money, I'm trying to attract the world's most fungible asset, right? That's what I'm trying to do. I'm trying to sell shares in exchange for the most fungible thing in the world, and I've got to go do that. So what I need to do is I need to build enough demand for what I want to sell, which is invisible product, right? It's hope, and I've got to build demand for that, and then I've got to see what price clears. And my job as a fundraiser is to do a really, really good job at building demand. Because the better I can do at building demand for my limited supply, I've only got so many shares I'm going to be willing to sell, the better I can do from a price perspective. But there's just going to be realities where I can only build so much demand, and you find out where that demand meets. And I think if your last watermark, if your last valuation is probably more than 18 months old at this point, you probably have had to grow a lot just to keep flat. And that's just the reality today.
Yeah, I mean, look, I see this all the time. People who raised at super overinflated valuations in the last 18 to 24 months, and they're trying to defend these. And it just, my advice to founders is the market is what the market is. You're not going to define the price for your deal. Your investors are. And you've got to be realistic. And if that means taking money at a down round to be able to accomplish what you need to do with your business, and I've given that advice to people in this room, you've got to do what it takes to get your business where you need to, and you have to be realistic. If stocks in your sector have gone from 20 times revenue to 5, you're down. You may not be down 80% like that, but you're down, and you've got to be realistic about what's out there, where other things in your sector are getting funded, and where that money is going to come in. And fighting to try to maintain an irrational valuation from overinflated markets is going to go badly. And when you go to investors and say, we're raising at 40, and then you come back 2 months later and go, we're raising at 30 now, and then you come back 6 months later and go, we're raising at 20 million valuation, you look like an idiot, and it's like an automatic no. It's a huge red flag.
Yeah, and I say, don't even go, we're raising at X, right? We're not raising at a valuation. We are raising X million of dollars. We're raising $5 million. Right. You're raising $2 million. Whatever it is, you're raising money. You are not going in term setting. And I completely agree. It just comes off bad. It comes off, really risks coming off naive, and then that hurts your credibility as well as an entrepreneur.
And I think the other thing to really understand, folks, for anybody who's been an entrepreneur for more than 1 or 2 startups, they've probably had one failure, if not more. And remember, there was a company that Charlie remembers that at one point the company was worth over $1.5 billion, and we ended up selling it for a small fraction of that. So remember that illiquid shares are illiquid, and it's only when you're able to monetize them that you get true value in your pocketbook. So it doesn't really matter what the paper value is. A lot of people thought they were very wealthy the last 10 years, and they found out they are not. So again, what matters is when it's time for some sort of liquidity event. That's what matters, what the valuation is. Let me ask 2 questions. You're the first one, I think. Go ahead. Yeah. Your name?
Karen, yeah, my name is Ram from TiEATL Startup.
Ram?
So Karen, Brian, and Howard, a question for all of you. So you talked about reaching 50 to 100 potential investors for fundraising, right? My first question is how to reach that 50 to 100 first, right? So sometimes I call people, they say, yeah, we'll talk, and then never return the call, and then it takes a lot of time. How do you go about it?
I'll jump in there. I mean, first thing, and Karen alluded to it earlier, is figure out which investors play in your sector and your stage. Do the work, look at other companies that are similar, and make sure that the people you're targeting are stage and sector appropriate. And then you've got to find some kind of warm intro. I mean, look, we'll look at the stuff that comes in unsolicited on our website, and I get 10 random inbounds on LinkedIn and Twitter and email every day, and I glance at them. But we've funded 23 deals, and only one of them came from a cold inbound.
So hear that, guys, warm introductions. LinkedIn is a wonderful tool. When we first started, many of us as first started as
But not
entrepreneurs.
just LinkedIn spamming people.
No.
Find somebody that knows those investors. And if you don't know them, network at events like this. Get out there, find the people. Find somebody like Karen or myself or others in the leadership here and ask them who they know that invests in your sector and stage. Maybe you can talk a little bit to how you found the investors that you guys.
Well said.
Yeah, I mean, I completely agree with that. And I'd say think about it in stages. So if you're going to go fundraise, there's a list building stage. And you want your Google Doc, and you want to build a list of what's every investor you know and what's every contact or friend you have who might know investors. And you're calling them up, not the investors first. You're calling up all the friends. You're building a list of, okay, here's now the 75 funds I have an inroad to. And then you're building the pack. First, you need your presentation. You need all your material ready to go. And then you need the email, which is, look, you're going to send your friends who are making intros this email that's a super short snippet, intro email. Here's the email. Can you pass this along to so-and-so? And you're not sending a, can you pass it along to people you know? No. I want an intro to name the fund, name the person. That's an email. If Joe's introing you to 5 people, you're sending Joe 5 different emails. If Sarah's entering you to 3 people, Sarah's getting 3 different emails. Those emails contain the snippet, they contain who they're introing you to. Like, this is hyper-personalized, like, account-based marketing is effectively, it's an enterprise sales role, it's account-based marketing, open blasts, don't land.
And you guys, they can't. That's one area you really don't want to, because you get one chance to make a good impression. And if you send spam email, you've blown it. So listen to what these gentlemen have said.
Yeah, that's
They've done
great
it.
advice too. I mean, oftentimes I'll see the same startup 5 different times from 5 different people that I know. Some of the people I know and know well and respect, and some of the people, like, I'm a connection on LinkedIn. I've never met them before, right? And so, like, you know, by the time I've seen it from the person I know, I've already looked at it and kind of dismissed it in my head. And it's going to take a lot from that person that I do know for me to be open to even taking a phone call, much less actually getting to an investment. So,
Great,
you know,
great guidance.
list building.
One
That's
over here.
exactly right.
Great, thanks.
My name is Ravi.
Ravi?
Ravi,
Uh-huh.
I'm an entrepreneur. I've raised capital in the past, but I'm going to turn the tables. What should a CEO look into an investor? Because, what if you're fortunate, you have a good business, and you have 5 people who want to invest in your company? What are the attributes that you would recommend that the CEO should look at? This is a strategic partner, and this may not be a good fit.
That's a great question, guys, and we need to spend a lot more time thinking about what we want from our investors, even in a tough capital market like this. Let me start, and then I'm going to ask you guys to jump in. I think the first thing is, what do you want from your investors? Money is probably the most, I think you said it, Howard, the most fungible of it. I mean, money, even though it's tight, money's still easy to come by. Do you want connections? Do you want mentoring? Do you want operational experience? Charlie talked about that earlier. Find out what you want, because that should match up. Gentlemen, what do you think?
Yeah, do your diligence on your investors. Find somebody in their portfolio company that you have some connectivity to, or somebody who can introduce you to, not the investor. Don't ask them to introduce you to somebody. Find someone in their portfolio and get the scoop. Right? What do they like to work with? If you're offering a board seat, what do they like to have on the board? Really do that work and understand. And what kind of value can they bring? You know, I can tell people all day about the things that our athletes can do, but the best people to help me get deals done are my existing portfolio companies. And if they're not happy and they're not telling their friends how great it is to work with Beyond the Game Network, then we're dead in the water.
And remember, again, you don't ask the investor. You need to do your homework. Find out what companies that investor has invested in before. Call them and say, what happened when I didn't make my numbers? Did I get fired? Did they pull back money? What happened? Ask those tough questions, because you don't want to be surprised, especially in a difficult environment. Howard, you've got some good points.
I mean, I was going to echo that. I think if you think of hiring a senior executive, right, you're going to ask tough questions in a collaborative way, but you're going to ask those questions. You're going to think about, what do I want in this role? What competencies really matter? And you're going to try and get as many of those filled. And then you're going to do reference checks. And you're going to try and understand, like, yes, when they did really well in a role, first of all, it's silent reference checks. When they did really well in a role, what stood out about them? How did they really add value? What positive change did they drive? And then find a role they didn't do so well in, and if you can, and what happened. And so I do think this question of when you miss your numbers, but if you find a portfolio company that's like really famous, it's the one they talk about in all of their investor meetings, like that's the one thinks really, really well. You want to talk to that person and say, hey, give me 2 or 3 companies that didn't work out so well. And then go find their CEOs and talk to them and filter out the information should be filtered out, but look for the signal.
Yeah, I mean, think about the reference checks you do on an employee. If something goes wrong, you can fire them. You cannot fire your investor. You are stuck with them until you get them their money back.
So well said. I think we've got time for 2 more. 2 more. One there and one there and one there. You're first. What's your name?
I'm Marcus Townsend.
Hey, Marcus.
So as like a young entrepreneur, like you're starting your first business, like what is some core advice that you can give to like a young person depending on college or even high school? Like because it kind of seems like this entrepreneur like you're just really romanticized in culture, but it's like I'm losing my hair. I'm 21. So like it's about the flowers here. So like what would be like your core advice for like a young entrepreneur?
Guys, give 3 pieces of advice. 2 pieces of advice.
Oh my goodness, this is a long one. Okay, 4 steps to the epiphany. Well, here, top books. 4 Steps to the Epiphany. Yeah, books to read. 4 Steps to the Epiphany, best book for finding product market fit. Crossing the Chasm, really old.
Jeffrey Moore.
Yeah, Jeffrey Moore. Best book for thinking about go-to-market strategy. Who, best book for hiring people. And then Turn the Ship Around, probably my favorite book on leadership from a practical perspective. Is that okay?
That's perfect. So read, again, there's so much great literature. When I started as an entrepreneur, when Charlie started, I don't think they even had a book about it. And now we have volumes of it.
Yeah, I
Brian.
mean, beyond, learn, read, listen to podcasts, watch YouTube channels around this. There's so much free information out there. Get out in the community. Go to events like this, go to Atlanta Tech Village, go to ATDC down by Georgia Tech, go to the Russell Center, work with the Goody Nation. There's so many amazing resources here in Atlanta to help first-time founders. Utilize them, maybe from your university as well, where you went to school, and then find mentors. Find people who have done it, either on the investor side or the startup side, and ask them to help. And you'll find, I think, it's certainly in Atlanta, you'll find a really supportive community on this.
Yeah.
I 100% agree with that. The number of people in this room that have been there for me so many times, and I'm just thankful that I can start to give back to so many of the next generation of entrepreneurs. So yes.
One piece of small thing though. I'd say the biggest thing I'd say before making a decision on a company to start, my biggest advice is speak to 100 different prospective customers. 4 Steps to the Epiphany, that first book, it's all about speaking to the customer. But I think that's the biggest mistake I see people make is they don't speak to, I say 100, but they don't speak to the actual customer. And you should be getting 80 to 90% of those people excited, like really excited. Like, yes, I have that problem. I wish someone could do that. If you're getting less than 80 or 90%, or for me, that would be at least a yellow flag for me.
And one more thing, 100% what Howard said, how much would they pay for it? Because I would love to have a Maserati, but I'm not willing to pay for it. So I'm going to tell you all day long, I want that car, but I'm not going to pay for it. So that's probably not a good market fit for me. Last question, and then we're done. I'm sorry, guys.
Yeah, I was part of the venture partner program with Republic, which is one of the largest crowdfunding platforms. I was in their first cohort of that, so I got to see a lot of what went on there at Republic, which is one of the 2 or 3 biggest players. I think crowdfunding can work in instances where you already have a large customer base and you're opening up an opportunity for that customer base, the people who already know your product and love you, to invest in your company. And those are the instances where I try to encourage founders to do that. Where we've seen crowdfunding really struggle is when you're in a B2B business, you don't have a lot of customers yet, you're very early, it's almost impossible, and it turns out to be a giant distraction. A bunch of time and energy to get set up, and then a bunch of money to do accounting audits and everything else. If you don't already have literally thousands, or preferably tens or hundreds of thousands of existing customers in some type of business, either B2B, small business, consumer, whatever it may be, I don't think crowdfunding is a good idea. If you're hoping you're just going to put out there and the magic internet's going to deliver you investors, it's a really bad use of time.
Remember, hope is not a strategy, and hoping you're going to get crowdfunded is not a strategy. Anything else, Howard?
No, I don't have any experience with it, but I hear it's tough unless you have a professional investor already leading the round is just filling in the last 10%.
Yeah, it can work if you don't have lots of customers. If you're in this amazing, Andreesen Horowitz led your A round, and and you've got 10 famous people on your cap table and other stuff like that. But if you're not that, you're just wasting your time.
You guys, I can't thank you enough. I thank my panelists. You guys are a wealth of knowledge. Thank you for being so open to share it with all of us. Big round of applause for these guys.
Thank you. Appreciate it.
Thank you, everyone.